So obviously the economy is changing. It's not getting better. We're going into some sort of a downturn. In some regions, it's going to be more severe than others. But what's becoming clear is that every business is going to be considering a layoff, and the majority of businesses are going to be performing some sort of a layoff. So the investor sentiment is a major driver for layoffs and layoff cycles. What investors are telling their companies is 20%. That seems to be the magic number, is we're looking for a 20% reduction in costs, which corresponds more times than not to a 20% reduction in headcount. That's 1 in 5 employees, which is a pretty significant cut and downsizing. This is coming, like I said, across the board to almost every company. Even companies that are profitable are seeing revenues decline, but they're also looking at their investments for the long run differently. All of those will come together to force the hands of most businesses into some sort of a layoff. So that's the bigger trend. Let's dive into what it means for you. The focus is on efficiency. That's what investors are asking for. They want their companies to be more efficient, to preserve their margins, and to make the company fit the size of the new customer base, the new opportunity size, which for most industries is shrinking. So what will that mean? What will the implications be? First, companies are looking to maintain service levels across their core business functions. Those are the areas of business and the products and services that they offer that make the company the most money. Those are the traditional focuses for core business. And the next one, they're going to start winding down. It's sort of the opposite. They'll start winding down unprofitable business units, product lines, product teams, anything that they were hoping long-term, sort of these speculative bets. Those initiatives are going to be wound down. Next, unfortunately, consultants and contractors are the first to go. They are the easiest to let go. There's no downsizing costs. They don't have to pay benefits or anything really outside of just giving them whatever the contract's notice is. They just won't renew the contract, or if they're able to, they'll cancel it right away. So a lot of contractors are going to be dropped off almost immediately. What comes after that is reducing your support staff, your non-essential personnel. You'll see a lighter weight organization from your administrative staff. Recruiting's another area that they'll start pulling from immediately. Those are the first wave of people that end up leaving. The focus will be on two sides as we get into those initial cuts and deeper cuts. They'll be on entry-level positions. Again, it's maintaining those service levels. If you have mid-level and senior-level employees, they'll be able to pick up the slack because entry-level folks don't do as much work. So entry-level goes first, but they're also going to be targeting very long tenure, very senior, those high compensation, high paid employees, because taking one of them away can do as much from a budget reduction standpoint as taking away 2 or sometimes even 3 mid-level employees. So maintaining service levels across core businesses often means the people at the very top end of the compensation scale and the people who are viewed as contributing the least, that entry-level side. Whether it's true or not, and unfortunately in many companies it's not true, without those top and bottom ends, service levels are not preserved. However, that's the perception, and that's what typically happens in these layoff waves. And there's going to be 3 sort of styles of layoff. The first one is very traditional. It's just the across-the-board cuts, where you get rid of a certain percentage. If it's 20%, you cut 20% of headcount. Every team gets impacted. Every organization takes the same hit. They're kind of dumb, but this is the traditional method. There are some new methods that big tech companies are leading the way in and showing more traditional businesses smarter ways to reduce headcount. The first one is eliminating roles that don't support sort of this new business climate and the new area of focus for the business, the new direction, which again is this return to core business. What is actually growing? What is actually bringing in revenue? Those are going to be the areas that are safer those areas which don't, that's where the layoffs are going to come from. And the next one, the big tech's driving, and they've done this for quite a while, which is sort of the stack ranking and performance review related job cuts, where people who don't meet a certain performance threshold are let go. And you can get rid of your bottom 20 or bottom 25% of employees, where you don't lose as much productivity because these are not high performers, but you're still getting rid of costs and you're doing that same level of reduction. So those will be the three main categories. So let's talk about that across the board cut, what I call the dumb layoff cycle. Any business that isn't profitable is probably going to be looking at this. You've already seen this in many startups and even larger businesses that are just shedding an across-the-board amount, 5%, 20%. Some startups are doing significantly more. I've seen 30% layoffs in startups that are not profitable. Any company that overhired. You're seeing now Google, Facebook, Microsoft has done it. Amazon's already gone through one round of it, and they're probably going to go through another round of it. But the big tech companies weren't the only ones that overhired. Many companies thought that pandemic trends were going to continue all the way through, and they didn't. So now they have more people than the business justifies. So that's the concept of overhiring. They expected business to continue to grow at the same rate as it did in 2021. But in 2022, it has not done that. Business is now contracting. So they simply don't need the staffing that they expected themselves to. What you'll typically see in these cuts is a drawback to your pre-hiring spree level. So if they started their hiring spree in 2020 or 2021, that's the amount of staffing and headcount that they'll cut back to, is that sort of pre-pandemic or early pandemic staffing levels. It's driven by seeing less business. That's the major driver. Whatever the reduction in business is the reduction in headcount. So if they revise their forward projections back 15%, you're going to see a 15% headcount cut. These are very discretionary. Your manager or director level has a whole lot of discretion in who stays and who goes. Like I said, they're arbitrary, they're inefficient. If you have a good relationship with your leader, you're probably a whole lot safer than if you don't have a strong relationship with leadership. It isn't fair. It's not about productivity in every case. It's very much perception-based, especially in these early rounds. Managers are willing to let go of people that they think they can live without versus people that they actually can live without. That's why I don't like these across-the-board cuts very much. I think the next type of cut is better, but it's very much more dangerous for people in our profession, because any business that's shifting focus away from innovation towards core business, well, data science and machine learning are considered innovation at most businesses. So at a company like Facebook or Google, AI is core business. Data science is a core business function. And so you're going to see fewer cuts to data science because they support the things that make the company money. But in more traditional businesses, data science and machine learning is associated with innovation, long-term returns, long-term growth. And so these are going to be the areas as businesses shift their focus. They will eliminate roles that are long-term bets, long-term projects and initiatives. They're going to reduce the amount of investment that they have on innovation, because remember, these are not producing revenue yet. So if the data team is a cost center versus a revenue generator, or if it breaks even through saving money or something like that, you'll see reductions because it's simply not a profitable organization. And so the organization is going to be cut down to the point where it can become profitable, whether that's cost savings, improved productivity across the firm, or if it's a revenue-generating organization, which is the best place for data science teams to be, because then it's not seen as purely innovation. So if you can quickly get to the point where you're producing products and getting them out the door, that's a safer place to be than being seen as a cost center and just innovation or long-term bets. Those will be the organizations in this sort of a layoff, this refocusing type of layoff, that will get the deepest cuts. What will end up happening is roles will be eliminated from those teams, but core business is still going to need people. And so the top talent out of the business units and roles that are being eliminated, you'll be given an opportunity to apply for other roles, basically transfer jobs from what you're doing now to doing something similar in another organization that does focus on the core business. Those roles will be available to the top performers. This is almost a stack ranking, which is what I'm going to get to next. But there will be opportunities to transfer within the business to roles that long-term will be much safer and have higher stability in businesses that are profitable. For those who are either without value-generating, value-centric capabilities, a lot of data professionals have, up until now, not been connected with business value. It's going to be difficult to transfer into one of these business or product line facing roles if that's where you've been in the past. And so those are the types of data professionals that are under the greatest threat. They're essentially not going to have a seat at the table anymore. And so these are kind of quiet layoffs where you get put on Meta calls it the 30-day list. You have 30 days to find a new role or you're going to be let go. And then the last one is performance-based. These are pretty straightforward. Anyone that's in the lower half of the performance stack ranking is definitely vulnerable, but it's the people at the bottom quarter who are in the greatest danger. At that point, in that bottom quartile, bottom 25%, there's a very high chance that for one reason or another, those employees are going to be let go. And when, it's an open question, but fairly certain over probably the next 6 months, you're going to see substantial cuts to low performers, people in that bottom 25%. So for anyone that has not been getting positive reviews, or if you're looking at this review cycle, because most businesses are going to wait for this review cycle to finish at end of year, beginning of year, that's when they'll be announcing performance-related layoffs and really letting go anyone that doesn't meet a particular criteria for performance. If you feel like you're in that category, it's a good time now to start looking for a role at a different company because companies are still hiring. Hiring freezes have not completely and across the board been implemented, and especially for data professionals, there is significant opportunity to transfer from one business to another right now because companies are still trying to catch up. This is one place that most businesses have underhired, is their data team. You can find data teams that are product facing or that support a core line of business. Those are great places to transfer into, higher job security. You'll have a starting sort of grace period. Most people have about 6 months until they're expected to become high performers. So you have that early grace period, but it's also a double-edged sword. People with the lowest seniority are usually the first ones to go. So if you go into one of those companies where they're doing an across-the-board cut, that dumb cut that I talked about, those people are going to be most vulnerable. So going into an organization that's very low maturity or that doesn't have a strong focus on data science, machine learning, if they're not generating revenue, those are a bad move. Those are moves that might actually put you in a worse spot than you're in right now. So performance-related cuts are the third ones, and really, if you're in that bottom 25%, just assume it's coming and protect your career by making a move now. Those are the main drivers for layoffs that are coming over the next, it's going to play out over the next 6 months for most companies. Bigger, more stable companies will do small, targeted layoffs and potentially a much larger layoff sometime towards the end of 2023. There will be unevenness in timing and when these are announced. For some companies, these will be sudden. You will show up and be terminated. At other companies, CEOs are beginning to drop indications to people that there will be some force reduction. So listen for CEOs saying things like, we need to be more efficient. We need to have a focus on profitability. We need employees to be contributing more. We want them to be more productive Any one of these types of languages an indicator from senior leadership, from the C-level, that layoffs are coming, that cutbacks are coming. Some companies will skate through this recession and not lay anyone off. They'll just do hiring freezes, be more selective. Apple is talking about being much more selective about who they hire and how they hire. But even large companies like Google, Microsoft, these are companies that have performed very well, even in the negative conditions that we're seeing. They are already beginning their first rounds of layoffs. So there are very few companies that are going to be immune. Listen to investor sentiment as well. If the stock price is getting absolutely hammered, if it's going down month after month, expect that senior leadership, in response to their stock prices tanking, are going to look for ways, and dropping headcount is pretty much the easiest way to reduce your overall cost structure. And every business knows there's some level of bloat where they can get rid of people and still maintain operating levels. So look for the signs of a layoff, which I've got another video that you can check out. And I explain the signs of a layoff and what to watch out for. But also consider your position. What part of the business are you in? Where is your business in this layoff cycle? Are they just about to lay people off? Or is this something that's more like 6 months, 9 months, maybe even 12 months down the road? Evaluate your individual circumstances, but figure out which one of those three drivers is most likely to be the one that impacts your company, and adapt your career strategy appropriately so that you can protect yourself and hopefully sail through this current downturn without any sort of negative career impact.